before we dig into tech and the latest on the regulatory front, I just want to get your take on the markets, where we're at here, especially given the big moves we've seen over the past week.
I think right now, just talking not tech but the broader markets, I think you have to be very concerned about how this gap between rates on the one hand and equities or credit on the other gets closed, right? And maybe both asset classes are a little bit right, a little bit wrong, but the bond market sort of pointing to a recession in 2020, in my mind, is way overstated. Having said that, looking at lower growth here, into the second half of the year than what you would have expected 3 months ago is probably, looks like it's going to happen. I think the question is that gap is huge, and how Powell's central to how that gap gets closed. For any person in that position, it's a very difficult maze to narrow, maze to sort of walk your way through. So it's going to be volatile for some time. I think there's a couple other factors that are hanging over allocators. With the market's up 16% year to date, do you really need to buy this dip when we don't know the efficacy of incrementally dovish policy to offset the negatives of trade tensions that only seem to be persistent, if not growing? Yeah,
and Denny, of course, if you have this low interest rate environment, how attractive does that make growth look here? But on the one hand, in terms of technology and investing in the sector, on the one hand, you have all the China trade tariff stuff playing out on a macro level, and on the other, you have all this increased regulatory scrutiny for the big cap tech companies, whether it is here in the U.S. or whether it is in Europe. How do you navigate?
Yeah, I think it's a great question, and generally the way that we're thinking about it is we're really focused on companies that are competitively advantaged and that win under or should prove resilient under a number of economic scenarios. So, the trade regulation's real. We have our views in terms of what the potential outcomes are for the large tech players. But then when we look through the market, we actually see some interesting areas of opportunity. I'll give you a great example, and that is the tower businesses, for example, the Crown Castles, the American Towers of the world, where they're structurally advantaged. They should benefit from densification of the telco infrastructure with 5G. And if we continue to see a lowering of interest rates, they continue to benefit as well because they're actually classified as REITs. And so there are really unique opportunities outside of where we might see the more significant headlines, where we're finding really interesting opportunities. I'd also highlight the semiconductor space, and while it's clearly a cyclical area, what we've seen so far during this downturn are margins and financial models that have held up incredibly well, and those businesses are just much more positively positioned than they have been historically, as we do start to see a recovery in the sector. Denny, so we continue to be enthusiastic.
Denny, you say 5G, AI, and IoT are trends that are driving the tech sector, but those seem really complicated in that some companies are holding off on spending ahead of 5G. AI, I mean, everybody's talking up AI, but sometimes it's hard to see who's got a real monetizable advantage. So when you think about what kinds of companies are really going to be able to leap ahead based on those themes versus which are just going to talk about it, how are you gauging?
Yeah, I think, as I mentioned on IoT, for example, as I mentioned the towers, really well positioned. As it relates to AI, you're right. Everybody's going to talk about it. And the reality is, in one form or another, it's going to get infused into every company and every industry. But more specifically, where you can directly invest against the theme, areas such as compute infrastructure required to do training and inference. So, think about the NVIDIAs and the Xilinxes of the world, for example, in the semiconductor space. The large cloud platforms, because they're providing infinite levels of compute and storage and network resources, combined with the algorithms to actually be able to benefit from AI. And then you can look into subsectors of technology like software as a service, where you have these providers that have captured tons of information from their customers, able to benchmark that, able to leverage it to provide new and innovative solutions to their customers on the enterprise level. So I think there are a lot of areas where it's not going to be a big boom where we're going to be able to point to, that's an AI-specific company. But we're going to be able to look at a lot of areas where AI is, incrementally positive for companies in the tech industry, as well as other industries as well, as it makes them more productive.
Michael, you mentioned volatility before. Certainly, we've seen a reemergence of it, more broadly and in certain markets more specifically. One area that you point out where it's been relatively subdued is NDX, is the NASDAQ 100. Why, and what does that signal to you?
I think it's been fascinating. So that spread between the VXN, which is the VIX for the NASDAQ, the tech-heavy NASDAQ, versus the VIX, which is the SPX, has been, it spiked a year and 3 months ago when Zuckerberg was in front of Congress, and it's been steadily climbing. That spread's been just falling and falling and falling, which is interesting, given that mega cap tech is in the, right in the foreground of the trade discussion. It's right in the foreground of this regulatory stuff. And it's also interesting in that look, when you look at the NASDAQ, it's up year to date 20%. The SPX is up 16%. If we get into a heightened risk off, what went up the most is going to go down the most. So I like the QQQs for hedging right now, having said that. But I think it's also, telling you that as it relates to this broader regulatory discussion for these big mega cap tech stories, that there's a lot of distance between an angry elected official and actual policy when it comes to actually, potentially re-engineering these business models.